All right, ready to dive into the world of intelligent investing.
Sounds good to me.
We've got Benjamin Graham's classic, The Intelligent Investor, as our guide,
Oh, classic.
and Jason Zweig's commentary to help us unpack it all.
Yeah. Zweig's commentary is always insightful.
It really is. So think of this deep dive as your cheat sheet to understanding the principles that built, fortunes.
Not just portfolios.
Exactly, not just portfolios.
Right.
Now, I know what you might be thinking.
What's that?
A book from 1949.
Yeah.
Is that really relevant today?
Good question.
It's a fair question.
Yeah.
But what's amazing is how Graham's wisdom has stood the test of time.
I think that's true of a lot of the classics, right?
Yeah, definitely.
Right.
That he wasn't just some armchair theorist either.
Right.
This guy started as a Wall Street clerk, worked his way up to running his own investment partnership,
Oh, wow.
and lived through some serious market mayhem.
Oh.
The kind that would make even the most seasoned trader sweat.
Yeah, I can imagine.
For instance, he rode the wave of the save old tire boom.
Save old tire.
Yeah, pocketing a cool 250% profit on the first day of trading.
Wow. 250%.
Not bad, right?
That's amazing.
Yeah.
But it sounds almost too good to be true.
Well, those stories rarely have happy endings.
Right.
And exactly. Turns out Save Old Tire was a total fraud.
Oh, no.
Exposed just months later.
Wow.
So Graham's experience with this and other market crashes really shaped his investment philosophy, leading him to advocate for in-depth analysis and a healthy dose of skepticism.
Makes sense.
Which brings us to the core of our deep dive.
Okay.
What exactly does Graham mean by an intelligent investor?
Well, it's not about having a genius-level IQ
Right.
or some secret formula.
Okay.
It's more about your temperament than your intellect.
Interesting.
Graham believed that successful investing hinges on being patient, disciplined, and most importantly, thinking for yourself.
So you're saying it's more about mastering your emotions
Precisely.
than mastering the market?
Yes, Graham saw how easily investors can get swept up
Oh, yeah.
in the euphoria of a bull market
Right.
or the panic of a crash.
Sure.
He compares the market to a manic depressive Mr. Market.
Mr. Market, okay.
Who's always offering to buy or sell your shares based on his wildly fluctuating moods.
I like that analogy.
Yeah,
So the intelligent investor doesn't play Mr. Market's game.
that's right.
Interesting. So instead of trying to outguess the market,
Yeah,
you're saying we should be more like detectives.
exactly.
Okay.
An intelligent investor carefully gathers evidence.
Right.
That's your financial data,
Uh-huh.
analyzes it meticulously,
Yeah.
and then makes decisions based on logic and reason,
Okay.
not on gut feeling or the latest headlines.
So it's like cutting through all the noise and hype
All right.
to get to the heart of what a business is actually worth.
Right. Exactly. Graham was adamant about the difference between investing and speculating.
Oh, God.
One builds wealth steadily over time, while the other is more akin to gambling.
Yeah.
And unfortunately, the house,
Yeah.
Wall Street in this case,
Yeah.
usually wins.
And that's where we see those cautionary tales like the dot-com bubble. Right?
Correct.
All those outlandish predictions
Yeah.
about companies with sky-high valuations but no real substance.
Yeah. Zweig's commentary highlights this perfectly
Yeah.
with the example of analyst Kevin Landis,
Kevin Landis.
who insisted those inflated valuations weren't a mania,
Even as the bubble was about to burst.
even as the bubble was about to burst. Yeah.
Wow.
We also see it with Motley Fool's Foolish Four formula,
Oh, yeah, right.
which encouraged investors to chase patterns in past data, often with disastrous results.
So how do we avoid falling into that speculation trap?
Right.
Is it all about finding the next hidden gem?
Well, while uncovering those opportunities is part of the game.
Yeah. Graham's key principle for avoiding speculation and mitigating risk is the margin of safety.
Okay, but isn't that just about avoiding losses?
It's so much more than that. Think of it as buying $1 for 50 cents. Even if things don't go perfectly,
Yeah.
you've built in a buffer to protect your capital
Okay.
and set yourself up for potentially significant gains.
I see.
This is what Graham did with Northern Pacific Railway.
Northern Pacific Railway, okay.
He realized the stock was drastically undervalued due to a mispriced dividend and overlooked asset value.
So essentially giving him that dollar for 50 cents deal.
Exactly.
So the margin of safety isn't about being overly cautious.
No.
It's about maximizing your potential upside by minimizing downside risks.
Precisely. It's about buying assets for significantly less than their intrinsic value, providing a cushion against unforeseen risks and market fluctuations. It's not just about avoiding losses.
It's about setting yourself up for potentially huge gains when the market eventually recognizes a company's true worth.
That makes a lot of sense.
Yeah.
So if I'm trying to apply this principle today, should I be poring over financial statements all day?
Well, that's where Graham makes a distinction between the defensive investor and the enterprising investor. He recognized that not everyone has the time, the temperament, or the expertise to be actively managing their portfolio.
So it's like choosing between being a chef who crafts elaborate meals from scratch versus someone who prefers to follow a simple, reliable recipe.
That's a great analogy.
Both can lead to satisfying results, depending on your individual preferences and skills.
Exactly, for most people, especially those who are just starting out. A passive approach using low-cost index funds is the most sensible and efficient way to build wealth.
Over the long term.
Over the long term, yeah.
So it's more about discipline and consistency.
Exactly.
Than trying to outsmart the market.
It's about tuning out the noise. Resisting the urge to chase the latest hot stock. And sticking to a well-defined plan.
That sounds a lot less stressful.
It absolutely is.
And constantly checking the stock ticker.
And even if you choose a more passive approach, Graham stresses the importance of research and independent thinking. You still need to understand what you're investing in and why.
So even if I'm investing in a broad market index fund, I should still be doing my homework on the companies that make up that index.
It's about being an informed investor, not just a passive participant.
That makes a lot of sense.
Yeah.
Welcome back to our deep dive into the intelligent investor.
Glad to be back.
So we've laid the groundwork for what it means to be an intelligent investor.
We have.
But let's be honest, the market can feel like a wild ride.
It can.
Even with the best intentions.
Definitely.
I've definitely caught myself getting swept up in those daily ups and downs.
It's easy to do.
It is.
Yeah.
And it's easy to lose sight of the bigger picture.
Absolutely.
So
that's precisely why Graham's insights on market fluctuations are so valuable. Remember his analogy of Mr. Market?
Oh, yeah. Mr.
Always there to tempt you with irrational offers based on his volatile mood swings.
That image really stuck with me.
Good.
So how do we avoid playing into Mr. Market's hands? Should we be trying to time the market?
Wow.
Buying low and selling high?
That's what a lot of the financial gurus seem to preach.
They do?
Yeah.
But I'm guessing Graham would disagree.
Graham would vehemently disagree. He believed that trying to predict short-term market movements is a fool's errand.
The fool's errand, all right.
A game that even seasoned experts rarely win.
Interesting.
Instead, he famously stated that the market is a voting machine in the short run, but a weighing machine in the long run.
So short-term price fluctuations are driven by emotions and speculation. But eventually, the true value of a business will shine through.
That's the key insight. An intelligent investor understands this and focuses on the long game.
The long game,
They tune out the daily noise of the market. And stay focused on the underlying fundamentals. They see these fluctuations not as threats, but as opportunities.
Opportunities.
Yes.
I guess I've always seen volatility as something to be feared. Not embraced.
But think of it this way. When Mr. Market is in a pessimistic mood, he's offering to sell you valuable assets at a discount. And when he's overly optimistic, he's willing to buy from you. At inflated prices. So the intelligent investor uses these mood swings to their advantage.
That's a pretty powerful way to reframe how we view market volatility.
It is.
But it sounds like it takes a lot of discipline.
It does.
To stay the course.
Yeah.
When everyone else is panicking or getting caught up in the hype.
Absolutely. Graham even went so far as to say that the typical investor would be better off if his stocks had no market quotation at all.
Wow. So he's basically saying that constantly checking stock prices can do more harm than good.
Exactly. It feeds into our emotional impulses and can lead to rash decisions.
Makes sense.
The intelligent investor, on the other hand, understands that the true value of their holdings isn't determined by the whims of the market, but by the long-term performance of the underlying businesses.
So how do we put this into practice? Is it just a matter of ignoring the market completely?
Well, while Graham wasn't a fan of market timing, he did advocate for what he called formula investing.
Formula investing.
This involves gradually adjusting your asset allocation. The mix of stocks and bonds in your portfolio based on the market's overall valuation.
So if the market seems overheated, I'd shift a portion of my portfolio from stocks to bonds. And then gradually shift back into stocks as valuations become more attractive.
Precisely. It's a systematic approach that helps you take advantage of market swings without trying to pinpoint the exact tops and bottoms. Which is virtually impossible to do consistently.
That seems like a more manageable approach.
It is.
Especially for someone like me who doesn't have the time or expertise to be constantly analyzing individual stocks.
Exactly. And there's another strategy that aligns perfectly with this approach.
What's that?
Dollar cost averaging.
Ah, yes, dollar cost averaging.
Have you heard of that?
I have. Isn't that where you invest a set amount of money?
Yes.
At regular intervals? Regardless of what the market is doing.
But investing consistently, you'll naturally buy more shares when prices are low and fewer shares when prices are high. This can lower your average cost per share over time.
It takes the emotion out of the equation.
It does.
Which I think is a major hurdle for a lot of investors.
It is,
Myself included.
And it also seems pretty easy to implement. Most brokerage accounts have options to automate these regular investments, frankly.
I think so. It's a simple yet powerful strategy.
It is.
That aligns perfectly with Graham's philosophy. Of discipline and long-term thinking.
Exactly.
Now, you mentioned earlier that Graham distinguishes between the defensive investor and the enterprising investor. It seems like everything we've discussed so far would fall under the defensive approach. Focusing on index funds, dollar cost averaging, not trying to time the market.
A lot of what we've covered so far applies to building a solid defensive portfolio, which Graham believed was suitable for most investors. But he also recognized that some individuals have the time, the temperament, and the expertise to take a more active role in managing their investments.
So the enterprising investor is more like the chef.
Exactly.
Who enjoys creating elaborate dishes from scratch. Meticulously selecting each ingredient.
They're willing to put in the extra effort to research individual companies, analyze financial statements, and potentially uncover hidden gems that the market has overlooked.
But even for those who choose the enterprising path, Graham emphasizes the importance of sticking to his core principles.
Absolutely.
A margin of safety, avoiding speculation, focusing on intrinsic value.
Whether you're a defensive investor or an enterprising investor. Graham's framework provides a solid foundation for making sound investment decisions.
That makes sense. So let's say I'm intrigued by the idea of becoming a more enterprising investor. Where do I even begin? It can feel overwhelming trying to sift through mountains of data and financial reports.
Graham dedicated a significant portion of The Intelligent Investor to guiding investors through the process of security analysis, breaking down complex concepts into manageable steps.
That's great to hear because I think a lot of people, including myself, assume that security analysis is only for Wall Street pros with fancy degrees.
Graham believed that any intelligent individual with the right approach and a willingness to learn, could effectively analyze a company and determine its intrinsic value.
I am officially intrigued. Let's dive into the world of security analysis and see what Graham has to offer. Welcome back to the final part of our deep dive. Into The Intelligent Investor. Great book. We've covered a lot of ground. From understanding market psychology and avoiding speculation to building a solid defensive portfolio.
It's a good foundation.
And now we're stepping into the realm of security analysis.
The nitty-gritty.
Something that, might sound daunting at first.
I could see that.
But as we've been saying, Graham believed that anyone could learn to do this effectively.
He did. He really demystified it.
Yeah, he made it accessible.
Yeah.
Which is reassuring because I think a lot of people, including myself, assume this is reserved for, the
pros.
The financial wizards.
Yeah, the Wall Street guys.
With fancy degrees.
Right, but Graham had a different view.
Yeah, so where do we begin?
Okay, so Graham starts with understanding a company's earnings power.
Earnings power, okay.
Looking at its past earnings record, its stability, and its potential for future growth.
So we're not just looking at 1 year's profits.
No.
But rather a track record over time.
Right, it's about seeing the bigger picture.
Okay.
And Graham emphasizes the importance of consistency.
Consistency, okay.
So a company with erratic earnings might be riskier than one with a more stable and predictable history.
That makes sense. It's like judging a restaurant.
Oh, yeah.
You'd rather go to one that's consistently good than one that has amazing food one day and terrible the next.
Exactly. Consistency builds trust. And confidence.
Yeah, I agree.
For both diners and investors.
So along with consistent earnings, what else should we be looking at?
Financial strength.
Okay.
It's crucial.
Right.
So we need to assess a company's debt levels, cash flow, and its ability to weather economic downturns.
So a company swimming in debt with barely enough cash to cover its bills is a red flag, even if its stock price seems tempting.
Absolutely. Financial stability is essential for long-term success.
Okay.
Graham also digs into a company's capital structure.
Capital structure.
The mix of debt and equity.
Okay.
It uses to finance its operations.
So a company that relies too heavily on debt might be more vulnerable to interest rate hikes or a sudden economic slowdown.
Exactly.
Kind of like a homeowner with a huge mortgage.
Yeah, I like that analogy.
And no emergency savings.
Yeah.
Right.
Precisely.
Makes sense.
And this is where Graham's margin of safety concept comes in again.
Oh, okay, right.
So buying stocks at a significant discount to their intrinsic value provides a cushion against these potential risks.
It's like having a built-in safety net for your investments.
Exactly.
Now, beyond the numbers, Graham also emphasized the importance of understanding the management team.
Right, the people behind the numbers.
Yeah.
He suggests asking some key questions.
Okay, like what?
Like, is the management reasonably efficient?
Okay.
And are the interests of the average outside shareholder receiving proper recognition?
Those are excellent questions to consider.
They are.
Even a financially sound company can struggle.
Oh, absolutely.
If its leaders are incompetent, unethical, or misaligned with shareholder interests.
It's like having a talented team of athletes.
Yeah, good analogy.
But a terrible coach.
Right. The potential might be there.
Yeah.
But poor leadership can squander it.
Exactly. Graham reminds us that investing is not just about analyzing numbers.
Right.
It's about understanding the people behind those numbers and their ability to create value over the long term.
So we're looking for companies with strong financials, consistent earnings, and a competent and trustworthy management team.
Absolutely.
But let's not forget about market psychology.
All right, Mr. Market.
The emotional waves that Graham so aptly described as Mr. Market.
We need to be aware of those psychological forces and how they can create opportunities for the intelligent investor.
Right. So the market doesn't always reflect true value.
No, it doesn't.
In the short term.
Right. Fear and greed can cause prices to swing wildly, creating those bargain issues.
Bargain issues, okay.
That Graham was always on the lookout for.
It's like those rare moments when a valuable antique ends up at a garage sale, just waiting for a discerning buyer to recognize its worth.
Exactly. It takes patience and the willingness to go against the crowd.
Yeah.
But those opportunities exist for those who are prepared to seize them.
So it seems like Graham's approach to security analysis is really about weaving together multiple perspectives.
It is.
Financial data, management quality, market sentiment.
Right.
To create a comprehensive picture
of
a company's true value.
That's a great way to put it.
Yeah.
Right.
And as we wrap up this deep dive, I think it's important to emphasize that Graham wasn't advocating for get-rich-quick schemes or chasing the latest hot stocks.
His approach is grounded in a long-term perspective.
Right.
Building a solid financial foundation.
Brick by brick.
Brick by brick, exactly.
He called it the central concept of investment.
The central concept of investment.
Okay? Buying assets for less than they're worth.
Right.
Minimizing risk and letting the power of compounding work its magic over time.
It's a powerful force.
It really is.
Yeah.
It's a reminder that intelligent investing is a journey.
It is.
Not a destination.
Right. And the intelligent investor serves as a timeless roadmap
for
navigating the complexities of the market with wisdom and confidence.
Now, we leave you with a question to ponder.
Okay.
If Graham were here today, what companies would he consider?
Good question.
Intelligent investments.
Yeah. What industries are being overlooked?
Right. Where are those hidden gems? Waiting to be discovered.
It's a treasure hunt.
It is. We hope this deep dive has equipped you to begin your own journey.
Your own journey,
toward becoming an intelligent investor.
It's a worthwhile journey.
Happy investing.
Happy investing.